Well, they say knowledge is power. Knowing where you are in the cycle is incredible power because it delineates what our strategies are going to be. So if we know what is going to happen or have a pretty strong idea what's going to happen, we can change our strategies and adjust to whatever the market environment possibly is, and we know what to do when things start appearing. Now, I've been talking about cycles. Now, if you came to our class in Phoenix, we'd be going over this in a little more detail, but I'm going to give you just a couple of quick thoughts on cycles, and you can take a look at it. We're going to be talking about where we are in the real estate cycle right today and why I think that we're still in the accumulation phase. Got plenty of time to accumulate properties. Really, this is the time when you make fortunes. But let's just start with a couple of these with cycles. You are certainly welcome to always send us questions or comments to michael@michaeldeville.com. We're also going to put this up on YouTube, and there is a place for you to put comments on that. We like to respond because we like to get your thoughts as well. And let's get right onto it. So let me go to my very, very first slide. Now, as you know, I believe in cycles. I think everything cycles. We have sunspot cycles. We have the seasonal cycles. We have business cycles. We have inflationary cycles and commodity cycles. And we talk about this in our workshops here in Phoenix, Arizona, just so that you are a much better investor and you understand where we are. Now, this is an absolutely perfect graph for looking at the interest rate cycle. You can see it. It's a perfect bell curve. And this goes over and it keeps repeating itself over and over. Now, it's a very, very long cycle. Typically, it's around 76 to 78 years long. This is a cycle. You can see that this actually starts somewhere in 1942, and it's just finishing here in 2020, and it's starting a second cycle. At least I think this is the second cycle. Now, right in the middle, so 39 years up, which from 1942 to 1981 brings us into Paul Volcker's era, and he destroyed inflation because there was an inflationary cycle going on at the same time. He destroyed inflation by rising interest rates and brought interest rates to the very, very peak. Short term, I think they were 21, 22, 23%, depending on who you were at the bank. And I think mortgages got out to be 14, 15, 16%. T-bills got to be right around 16, 17%. And they peaked. And then they've come down for 39 years. So if they peaked in 1982, well, 39 years later is like a perfect, brings you right down to 2020 and 2021. So we think in our research that interest rates have bottomed. And as an investor, you need to realize that we're probably not going to be enjoying much more interest rates lowering. Now, we've been spoiled for the last 30 or 40 years with interest rates continually going down and going down and going down. There's a whole generation of investors that have never experienced higher interest rates. Well, we think we're going to be entering into higher interest rates. So that colors some of our thoughts as where we want to be and how we're going to approach the marketplace. Now, that is a perfect cycle. So let me go to my real estate cycle and let me go to my next slide so that you can take a look. And again, if you have comments, you're welcome to do this with us and share them to us. Now, my next cycle, this is a stylized version. I've shown this many, many times on my YouTube videos. So we typically look at about an 18-year cycle. It's actually about 18.6 year cycle. This is the stylized version of it. Now, oftentimes there's always a mid-cycle correction. Sometimes there's a mid-cycle double correction, which we had in this current cycle, and we've not completed. So we're not even close to being completed. We're still somewhere here in the accumulation phase, and we haven't even entered into the explosive phase. Now, the explosive phase is really the last 2.5 years of the cycle. That is where prices just literally go to the max. Now, why do I say we're not near the end? Because there's never been a cycle less than 17 years. And we're not even close to being at the end of a 18-year cycle, or even being close to a cycle. So let me go to my next slide, and you can see why I say this. So you as an investor, you as trying to do something with your retirement account. Now, I'm talking to baby boomers because we need income. You need dependable, consistent monthly income, and you need it to grow and be protected, for your purchasing power protected. And the only way you can do that is something that grows and follows along with inflation, because inflation is a compounding effect. And we've talked about that too. Look at my other videos. You'll see that, over the last 20 years that our purchasing power has greatly been eroded. So let me go to my next slide and we'll just talk about that. Now, this is actual data coming out of Federal Reserve electronic data. You can go into it and take a look. You can play with the figures. You can do all that you want. It's a live link. It has tremendous data. They've allowed me to use some of their slides. So now I went back to this slide, and so I'm going to go through 2 or 3 of these really quickly. I don't want to belabor it too much, but this is one of my favorites because I started in business in 1972. When I got into business, they were just coming out of the worst recession since the Great Depression in the United States. People were looking at me cross-eyed, like saying, why on earth would you be wanting to get into the real estate business? Well, if you take a look, now this is an expanded version. Now you can see there's a double top. We got to the top at Q3 of 1968, and the final uptick was 1969. But I'm going to tell you, most of the momentum and the buyers were already done. It was already spent. So there's two peaks. You want to be able to sell by the first peak on anything that you need to sell. We want to be sold here. Now, prices are still slightly rising, but the volume has gone out of it. The pressure has gone out of the housing market. Now, this is a perfect illustration of the accumulation phase. It's generally a pretty long phase. Then you get into the explosive phase, and that is not. So the explosive phase is right here, and prices climb. Let me go to my next slide. Now, again, 18 years later, we're looking at another peak. 1989, a double peak. 89 fourth quarter, 1990 second quarter. But again, perfect. You can see this is a really long accumulation phase. It got up to here. Then we started into the final explosive phase. And the explosive phase really is this peak here. This is finishing the explosive phase. The market doesn't know that it's about to roll over, but we can tell. There's lots and lots of tells. Now, what's nice about being in business for 50 years, I've seen this before. I've been through this. By the time we got to 1980, 1989, and 1990, I'm thinking, wow, I've seen this before. I know what's going to happen. And that's when I started realizing that we had some cycles, some cyclical things in the economy. And of course, when we get into the digital age, all that data opens up for you. And anybody can go in and start looking at all these things, and you can start making your own decisions. But I've already done a lot of that, and I'm going to tell you what's going to happen now. So let me go to my very next slide, and let's talk about that one. Now, this is the one everyone knows. Now, right here, I'm going to tell you, there were so many investors saying, I am never going to get into the real estate business again. I don't ever want to have rentals. But I'm going to tell you, those were speculators. If you were actually a real estate investor, you were fine. I was fine. My wife and I went and took our kids to Australia for 3 months, like we typically did, because the rents were never really affected. Remember, rents are up there with the food, water, and shelter. People need a place to live. Last thing they're going to give up is their house and a roof over the house of the family. Again, though, let me just take a look at it. This is a very good illustration. Now, I remember this clear as a bell. I was here in Phoenix. We were the poster child for the bubble. But here you go. Here comes the accumulation phase. It's starting to get in here, and then we get into the explosive phase. And in Scottsdale, Arizona, in 2005, which would be right through here, we went up 54% in 1 year. And when you got up to here, things were starting to slow down. So you could tell that it was going on. So we get this huge, enormous rush. Now, we have strategies for this. One of the things I'm going to tell you is that you buy twice as much as what you think you're going to want. In this time frame, in the accumulation phase, you buy doubles, and you want to sell one of them in here in the explosive phase. We quit buying here. So in 2006, my whole group, we quit buying. This was a selling opportunity, was not a buying opportunity. We quit buying at the beginning of 2005. We no longer purchased the properties because we knew that the market was going to implode. I called every last one of my investors, explained to them that the cycle was ending. And we got here in 2006. I told them that the direction of the market was going to be down. And those who wanted to sell, we sold, and most everybody decided to keep. Now, keep in mind, we're investors. We're income investors. We like the fact that the prices go up, but we're interested in income. So for me as a baby boomer, this kept giving me income. It gave me income for my life. We could continue with my life. And most of my investors were the same thing. We are investors. The ones that got clobbered were the ones that went in with no money down. They did ninja loans and no document loans. They went in and told mortgage brokers that, oh yeah, I make $200,000-$300,000 a year and I can certainly afford this house. And of course, they were just thinking they're going to buy the house, put it on the market, make $100,000 the next day, and the market stopped. So here we are. It's clear as a bell, a double peak in 2006, 2007. We want you, if you bought two, we want you to sell one here. We want you to sell one here, and hopefully you get enough equity buildup. Now, I know this may sound like maybe this is fantastic, but we're hoping in this explosive phase that if you bought two, one of those would be able to be sold and pay most of the mortgage off, if not all of the mortgage off on the other property. So you go into this completion cycle really with a free and clear property, and most of your risk is going to be mitigated. We do not want to be highly leveraged here. Absolutely not. We do not want to be highly leveraged at all. This is where we quit buying here right prior to the first peak. We don't want to buy. This is a selling opportunity for us. And again, so let me just count this. This is going to be simplified, but when you look at an 18-year cycle, it's 14 years up and 4 years down. That's as simple as you can possibly get. There's typically a mid-cycle correction or two. This last one had 2 cycles, but my model predicted both of those and nailed them to the month. So I feel pretty confident about it. But again, it's a model. It doesn't necessarily mean it's going to have to be correct. It's been correct so far. Maybe it's going to fail. But if it follows the rest of the markets, it's 14 years up and 4 down. So here we are, Q7. Let's just count them. Boom, 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 boom. Here's 2011. And sure enough, there it bottoms in 2011 and starts heading back. Now, this is late 2011 and then starts heading up into the new marketplace. And here it is now. So we've got 2006, 2007. You can see the double peak just as clear as a bell. You see the final down here on the 4 years. So just add 4 to 7, 11, and there it is. That's the bottom of the cycle. And beyond a shadow of a doubt, there it starts again and starts going up. Now, the question, if it's 14 years up and 4 years down, and it restarted the cycle in the 3rd or 4th quarter of 2011, and it's 14 years up. Now, we get much more precise than this, but 14 and 11 is 25. And I think that's the uptick. So we want to back that back a year. So the end of 4th quarter 2023, 1st quarter of 2024, if we have any selling to do, we want to be doing the selling, because we probably don't want to be doing much buying 2004 through 2024 through 2025. We want to be selling most of our properties, if anything, that we have. So we do this so that you can, if on a larger scale, a lot of our investors buy 20 properties, and we sell 10, and you have 10 free and clear properties that are just throwing off pure, unadulterated cash flow. It's just a wonderful thing for you to do. Here's an opportunity for you to get 10, 20, 30 properties free and clear and let the market do most of the heavy lifting for you. This is an opportunity that only comes along every 18 years, and it's staring you in the face. Let me go to my next slide. Now, if you like my videos, give me a big thumbs up. That really helps with our marketing. If you like our videos, you can subscribe. That way, every time we do one of these, one will pop into your email. If it excites you, you can watch it. If not, just delete it. You're always welcome to send us comments to michael@michaeldeville.com. Now, if you're just getting into the business and just becoming a real estate investor, real estate investing for beginners will give you a great investment foundation. Now, let me just recap. I think we've got 2 or 3 years yet, maybe 4 years, before the end of the market and we go into completion. Completion, this will be the third time I've gone through completion. It's not the end of the world, it's just a natural fact. So then it's going to go through completion and we're going to start over again. But now here's a perfect opportunity for you to accumulate properties. And if everything goes as planned, we can sell a number of these properties, pay off your debt, and you come and get a free and clear portfolio that's just throwing off unmitigated cash flow, just straight cash flow. How good is that? And of course, when your properties are free and clear, it really mitigates your risk and allows your retirement so much better for retirement. Even if you only if you did one or two, if you did two properties and he went through this and just sold one of them and paid the other one off, wouldn't that just be wonderful to have a property that's just free and clear, just sending you a check each and every month? You know, each one of these properties, it generates between $1,200 and $1,500 net each and every month net. So these properties anywhere from $15,000 to $18,000 net a year. Multiply that by 10, and that's $10,000 to $15,000 a month, or $150,000 to $180,000 a year. That is just not unusual for our clients to have that. We're here to help you any way we possibly can. I'll talk to you, your spouse, your financial advisor. We're in the real estate business. We do a great job. We know what we're doing. We've got great property managers. You do not need to be the landlord. You can strictly be the investor. Be passive. You don't even need to see the properties if you don't want to. We'd love you to come here and see them. You know, come and meet us, shake our hands, and we'll go out and take a look at the properties. We want you to do that. But the three great markets of the United States are going to do exceptionally well. And I believe that everywhere in the United States is going to do well. If you're going to be investing new money, there's no reason you can't go to the three great markets of Florida, Texas, and Arizona, where the trends are incredible, where you're getting organic growth. So you'll get organic growth on top of whatever inflation there is. So you'll actually be growing your business, be growing your investment, and you'll be growing your cash flow and protecting your purchasing power. So again, if you want to reach me, I'm at michael@michaeldeville.com. We'd love your business. Thank you so very much. Bye-bye now.